Welcome to our webinar, Reducing Corporate Fraud Risk for European Perspectives. My name is Jens Poll. I'm the Corporate Governance Policy Group Chair of Accountancy Europe, and in my real life, I'm Audit Committee Chair in several companies. First of all, I would like to set the scene with some very brief remarks, and then I will introduce you to our panel. The consequences of corporate fraud can weaken public confidence in markets and weaken trust, and having long-lasting, damaging effects on society. So the need to strengthen Europe's corporate reporting ecosystem to better deal with corporate failures appears to be central to the Commission's current reflections on potential legislative changes in 2023. The purpose of this event is to try to encourage focus on the steps that all parties can take to improve the quality of corporate reporting, with an emphasis on practical measures that can deliver real change. Such measures should result in strengthening of the core audit and greater clarity over responsibilities of management and auditors for internal control frameworks, including fraud and going concern. A recent ICA-EW paper, Sharpening the Focus on Corporate Fraud and Audit Firm Perspective, suggests that many audit firms are taking practical steps to increase the rigor of work around fraud. With this session, we want to address the behavioral, logistical, and other measures to timely apprehension of fraud. And first of all, I would like to introduce now you to the panel, and then each of the panelists will intervene with a short statement of 5 minutes. And then we will have an exchange at panel level. And then we have time for Q&A from you. And you see, we have Slido activated where you can put your questions, and we will try to answer them all. So that's the agenda for this morning. And I'm now very happy to introduce you to my fellow panelists. First of all, Mart Möllmann. He is Deputy Head of Unit C1 at DG FISMA at the European Commission. He will give us reflections from perspectives of the European Commission on improving the corporate reporting ecosystem. Then we have John Bedermacher. He is ICAIA President and CAE at Euroclear. He will give us considerations related to how internal audit functions support and evaluates fraud risk management in a company. Then we have Marianne van Kimmenade from NBA. She is Senior Policy Advisor on Fraud and Public Sector at the Dutch Institute. And she will give us insights from NBA report, Exploratory Root Cause Analysis into Fraud and Discussion in the Netherlands on Auditors Reporting and Fraud. Then we have Catherine Bagshaw from ICAEW. She is Senior Manager on Auditing Standards, and she will give us insights from the ICAEW paper, Sharpening the Focus on Corporate Fraud and Related Research. And last but not least, we have Nigel Ivor. He is Chartered Accountant and Fraud Detective, and he will share considerations on the characteristics of fraud, how all actors can help to detect fraud, opportunities, and limitations of technology. So this is our very diverse panel, and I'm happy to welcome, first of all, Mart Möllmann from the European Commission. Mart.
Yes, thanks a lot, Jens. I hope you can see me and hear me.
Yes.
Very good. No, good morning, everyone. Very happy that Accountancy Europe and the Institute of Chartered Accountants in England and Wales have organized this webinar. As you have surely heard yesterday, Commissioner McGuinness has set out the way forward on our corporate reporting initiative. She noted lots of support for the holistic approach that we have taken, including all the 3 pillars of the corporate reporting ecosystem: corporate governance, auditing, and supervision. Now, important, I think, for today's topic is that she noted the high level of interest of stakeholders in better risk management and internal controls in companies, and in strengthening the responsibilities of boards to ensure good corporate reporting. She also explained that we need to deepen our assessments of the problems with the audit framework and how to improve audit quality. And she also made clear that we need more time to build consensus on policy options, and we'll continue to engage with stakeholders and follow the holistic approach that covers the whole corporate reporting ecosystem. Now, I think in our view, today's webinar is one step further in this process. And given that we look through the lens of corporate reporting, I would say that not all fraud taking place in a company is equally relevant. There can be small frauds or other acts that are criminal in nature, but do not impact corporate reporting as such. And if we look at the EU legislative framework, in the Accounting Directive, Article 20, it basically states that the corporate governance statement of listed companies should contain a description of the main features of the undertaking's internal control and risk management system in relation to the financial reporting process. So that is the lens through which we look, at least from our perspective, to fraud. Now, of course, smaller criminal acts can become systematic for companies, which can in turn create problems for their reporting. However, I think it's good to take the perspective that corporate reporting is the lens through which we look. Now, in EU legislation, it is very clear who is primarily responsible for the correctness of corporate reporting. Both the Accounting Directive and the Transparency Directive refer to the responsibility and liability of the issuer of the board. Now, company boards and management have a large freedom on how to implement in practice this responsibility. And I would mention 2 things that appear important to me. First, how do the other 2 pillars of the corporate reporting ecosystem function? Is there a serious attention to these issues from auditors and supervisors? But also, what are the risks for company boards if something goes wrong with their reporting, including due to fraud? I think this is the first thing that is very important. Second thing, a proper tone at the top combined with the implementation in practice of good internal controls and risk management systems. It's of course great if the tone at the top is good, but if it's not supported in practice with good systems and controls, there is quite a risk it will fail at some point. And at the same time, good systems, if not supported by a culture in a company and the tone at the top, for instance, because it might be seen as a cost, could risk failing at a certain moment. Now, of course, it's not only the company boards or the management, but also the audit committee that has an important task. And then there, the audit directive, the EU audit directive says that the audit committee should basically look at the effectiveness of the undertaking's internal quality control and risk management systems regarding, again, the financial reporting of the audited committee. So we have the audit committee, we have the company board, we have the management. But of course, in addition to these controls embedded in the company itself, auditors have been tasked to provide additional assurance, including in relation to fraud. And this task of the auditor is an essential public interest role, as was underlined also by Commissioner McGuinness at previous occasions. Now, the audit directive mentions fraud in relation to professional skepticism of the auditor, meaning an attitude that includes a questioning mind, being alert to conditions which may indicate possible misstatement due to error or fraud, and a critical assessment of audit evidence. The audit regulation, the EU audit regulation, adds specific obligations of auditors on this. It explicitly states that the audit report should contain a description of the most significant assessed risks of material misstatement, including risk of material misstatement due to fraud. And the auditor has to explain to what extent the statutory audit was considered capable of detecting irregularities, including fraud. Now, auditors also have an obligation to report suspected irregularities, even to supervisors, if the audited entity does not investigate the issue. Now, what is quite interesting is that the study on the implementation of the audit framework that we published yesterday has looked into the implementation of these provisions. Now, what struck me is that 99% of the auditors in the sample stated that sufficient and appropriate audit evidence was available to them to detect irregularities, including fraud. Now, that percentage, on the one hand, makes me feel very comfortable. Auditors are quite convinced that they have all the elements available to look into this issue. But on the other hand, it seems quite high to me. Is this confidence always justified? Now, to conclude on this point of auditors, they have a clear public interest task to detect fraud. Company boards, audit committees have clear responsibilities in relation to internal controls, risk management, and fraud. Fraud undermines trust in companies, in auditors, in supervisors, in markets, and between employees. And I think the Wirecard failure has shown us that it can also be extremely costly. And I think it's therefore in everyone's interest to detect fraud and to take action, except maybe in the interest of the perpetrator of the fraud. So I'm looking very much forward to our discussion today on how to reduce fraud. And of course, we are looking in particular from the perspective of what should the regulator do in respect of these issues. Thank you very much for your attention.
Thank you, Ward, for this very interesting introduction. And we are just in time, so to say, after the Commissioner's speech yesterday afternoon. So next is Catherine Bagshaw. Catherine, it's on you.
Thank you, Jens, and thank you, Accountancy Europe, for organising this event with ICAW. It's on an important subject that isn't going away anytime soon, but it is changing fraud. It's a complex subject, and it's sometimes unhelpfully reduced to oversimplistic sound bites. And as Jens said in his introduction, ICAW recently put out a publication on fraud. Now, I'm going to use old technology here. This is what it looks like, and I realise that you're looking at this backwards, but the title is Sharpening the Focus on Corporate Fraud, and then in smaller letters underneath, an audit firm perspective. And there is a link to this publication on the Accountancy Europe webpage for this event. Now, as I'm sure you know, the media coverage of the profession in the UK is relentlessly negative, as it is in other parts of Europe. And some of that coverage is no doubt well deserved. But this is a debate in which auditors don't really have much of a voice. They are too often portrayed as simply venal, self-interested, and completely indifferent to fraud. And we know, all of us know, that that simply isn't true. No auditor sets out to miss a material fraud. Now, we don't say, oh, it's just a matter of a few bad apples, because there are for sure things that need to be done by the profession as a whole in this and many other areas. But what we wanted to do with this publication was to showcase what firms have been doing in this area in recent years and what they continue to do. They really do put a lot of time, effort, and money in trying to understand their own biases better, for example, into trying to make sure that their audit processes don't result in red flags being ignored under pressure, and making sure that all of their staff recognise a red flag when they see one and know what to do about it. And I do have the sense, having talked to a lot of people about this, that there is movement in this area. We added recommendations to this report, recommendations for auditors, recommendations for companies, and recommendations for government and regulators, what they need to do differently and what they need to do more of. And among other things, we asked the auditors to step up their efforts to change culture, behaviour, and mindset. It all takes time, particularly in very large organisations. We asked the companies to respond more actively to concerns expressed by auditors, and we asked government and regulators to play their part by sharing their learnings more widely. We also asked them to make better use of the existing sanctions available to them to punish companies that mislead auditors. Don't change the rules when you can enforce the ones you've already got. So we did 14 interviews of audit firm partners to produce this, and the publication is built around what they said. And one of the things they all kept saying was that there isn't enough focus on the role of companies in fraud. Too easy to regulate auditors because they're already regulated. And I was pleased to hear Ward Molman note this in his introduction. As a result of that, this publication became the first of two. The second publication is also built around 14 interviews, 14 different interviews. It's 14 coincidentally, but they're interviews with audit committee chairs. And those audit committee chairs are in Europe, Asia, and North America, as well as the UK. And that second publication should be out in the first quarter of 2023. Now, maybe I need to get out more, but it was very interesting talking to those audit committee chairs, mainly because their views were really quite divergent in some areas. So, for example, one of the questions we asked them was, what keeps you awake at night as an audit committee chair? And we got some predictably silly answers to that. But one thing they all highlighted was cyber. The differences started to emerge when we talked about how they approach cyber risks. And another thing that became clear, although it shouldn't be a surprise, is that for the vast majority, fraud is just another risk. It's not the only risk, and it's rarely the main one. Now, it's well known that in the UK, we have an audit and corporate governance reform agenda. It's been going on a while, and it's very wide-ranging. I won't burden you with a history of it, but suffice to say that one key requirement in the area of fraud will be for companies to make a statement about the steps they've taken to prevent and detect fraud. It was suggested that auditors should also be required to report on that statement, but that particular recommendation was dropped. And as many of you know, there was also a suggestion that some sort of SOX style reporting requirement should be introduced through legislation. But that was also dropped. And I should say that it was dropped in the face of a lot of opposition from companies rather than auditors. We also have some newish auditor reporting requirements in relation to fraud. Since 2019, all UK audit reports, not just the big ones, have had to include an explanation of, and I quote, the extent to which the audit was considered capable of detecting irregularities, including fraud. Now, in practice, that involves auditors explaining in the audit report what the biggest fraud risks were in their minds and how they as a firm approach them. And our regulator, the Financial Reporting Council, analysed these disclosures in about 400 listed company audit reports issued in 2021. Now, there's nothing unexpected in there. They've got the average length of the reports, which is about 600 words. The main risks the firms reported were about management override, revenue recognition and estimates. And not very surprisingly, they're asking for less boilerplate, but it is a step forward. From an ICAW point of view, when we started to think about this, we realised that we really do have quite a lot of material touching on fraud. It's an important subject. And just by way of example, there are 3 films we've produced recently. They're called All Too Familiar, False Assurance, and Without Question. Some of you may have seen 1 or 2 of them. They all touch on fraud or money laundering or some sort of economic crime. And they all look at the pressures auditors are under when they're trying to make difficult decisions when they've got deadlines to meet. They aren't talking heads videos, they're believable stories. We've used professional actors and in some cases quite well-known ones. And these stories don't all have happy endings. In fact, I don't think any of them do, really. This is a really big subject. I'll stop there and hand back to you, Jens. Very much looking forward to the discussion. Thank you.
Thank you, Catherine, for this inside view in your papers you have produced or are in the process of producing. Now, John Bedermacher, it's on you, John.
Thank you, Jens, and thank you, Accountancy Europe, for having the ECIIA on board in this panel. Also because we believe that the interaction between internal audit and external audit will be growing in the coming future. Well, following Catherine's example, I will show you the paper that the ECI, not the ECI, but IAA Global wrote about internal audit and fraud. There is also in our international professional practices framework, there are several articles that point out fraud. First one on knowledge, and the other one on the fact that in each engagement, the probability of fraud should be considered. And looking at internal audit, I think I want to split up my contribution in two parts. One is what are we regularly doing every day in our audit world? That's operational audits and IT audits. And in the past, as you know, that was looking at process and system. But now over the last, let's say, 4 or 5 years, the behavior of people, so the people side has been integrated into what we call integrated audits. And I think looking at fraud, that is a really important matter because a fraud always starts with something that is used in a process or in a system, but it's also always done by people. So the people component is really important. With integrating that into our audits, are we able to predict it? No, of course not. That's unfortunately impossible for all of us. But in our audits, we can have a better look at fraud signals that might elevate into a real fraud case, but also look at the context and the environment that we audit to see whether there are signals out there that might predict some kind of fraud. And for instance, in a very small example, if you look at cost claiming and people committing small frauds with that, with data analysis, we are almost able to predict the behavior of people in that sense. And that's, of course, a very important development as well. Also, with the new products that we added over the last years, looking at governance and strategy control cycle audits, but certainly culture and behavioral audits, and we have advanced our view on how people impact processes and systems, because after all, every fraud case is about people. And then looking at the history on my personal side, I have done many fraud cases in the 40 years that I'm auditor now. And in all cases, looking back at the fraud case, everybody had seen signals. And also, if you look at the first line, second line, third line, but even the external auditors, looking back at a fraud case or any big incident, we all had signals. So the main thing that we should be doing all together is join these signals. Maybe sometimes informally, but also formally, join all the signals that we have. Well, then looking at fraud risk and also prevention, I think, and that's what also is provided in that practice guide that the IA has written, is that internal audit, of course, audits the fraud risk framework, the fraud prevention and detection framework, and looking at the control environment, looking at the risk assessment that was done by the company, looking at culture that is being built, at training, and also at the monitoring that is out there by the second line functions, in most cases, compliance and risk management. Also, internal audit can participate in fraud investigations. That is not very common in each internal audit division, but in many it is. And then sometimes as the leading party, but also sometimes as a contributor when, for instance, compliance is doing the audits, the investigation. And then what you also see in internal audit is that chief audit executive is part of some kind of committee within the company that basically gets the signals, gets the whistleblower cases, the speak up cases, and decides what needs to be done with such a signal. Or when a fraud signal is detected, that committee joins. Usually legal is there, compliance officers there, risk management is there, and the chief audit executive, and they kind of look at the case, what is the best way to work with it. Well, I also thought about what is so difficult for internal audit in this area. Well, first of all, looking at the risk in focus that was done throughout Europe by the ECIIA, the fraud risk is on number 14 on the list. So basically, there are 13 risks that the internal auditors view as more important and more visible to them. So I don't know if that's a matter of awareness, but I think it's something to look at. Another thing is making it difficult for internal audit is that if you are into an audit and you have a fraud signal, when is the time that you take that fraud signal into making it an investigation. So when do you go from an audit to an investigation? And that's the really hardest point for internal audit. And within the divisions that I've been leading over the last 10, 15 years, we did some training specifically on that point. And then the next question is, if you enter into an investigation, are you keeping it for internal audit, or are you adding external forensic auditors? That's also a very important question. And that is very dependent also on the flavor that the company wants to have. When I was working at SNS Real, a Dutch insurance company, we took a very major fraud and did it all by ourselves. But that is dangerous in the sense of image, because then internal audit, it might look like an investigator more than a division that helps you improve your processes and your culture. So that's the next question: how to protect your image if you're also active in doing fraud investigations. That's also something to discuss. And then the last point, I think, knowledge, of course, in a, let's say, a common internal audit division will not be that well advanced. So that's also something that we should work on from the internal audit world. Thank you.
Thank you, John, for this insight, practical insight. And I think we will come back during our discussion to the difference between the audit function and the investigation function. So, and when you are switching from the one to the other. So thank you. Now it's Marianne van Kemenade, and you will give us insight to your root cause analysis.
Yes, thank you, Jens. Thank you to have the MBA in this webinar. I first want to, is it possible? I don't know. I have a slide on this on the screen, so I will talk you through the slides. But in the Netherlands, we have the Dutch quartermasters, and I think most of you know about them. And they, we got a request as MBA from them that we had to do a root cause analysis. Why accountants don't detect fraud at all, or fraud not on time. So we did that root cause analysis in the spring of 2022, and we focused only on the role of the accountants in that. And it's important to realize that the accountant is not the only one in the whole chain, and all former speakers talked about the role of all internal auditors, the companies themselves, but the auditor is part of the chain, and we have to realize that first of all, most important frauds are not detected by auditors themselves, but they come from the chain, they come from whistleblowers, personnel in organizations. So when it comes to detection of fraud, the auditor is dependent about the quality of the control and monitoring system of his clients. But fraud is very difficult. It's always concealed. When you talk about fraud, boards of entities get a sort of irritation, because fraud is not a nice subject to talk about, specific when it comes to sorts of management override and the role and the integrity of the board itself. So the MBA conducted a root cause analysis, and we did that with information from 12 audit firms, very large firms, the big 6 in the Netherlands, and also 6 small firms, small audit firms. We got information from all the audit firms, we got fraud causes, and we got internal root cause analysis from the organizations themselves. And when I talk about the results, you see them here on the left side of the screen. And the most important and conclusion that we took as MBA is that fraud needs more professional, a more critical attitude from the auditor. And then it comes to the role identity. I heard John Bendemacher say that fraud is only probably the 13th or 14th risk. So internal auditors have more other risks to analyze before they come to fraud. We also see the same in the role of an auditor. An auditor has a very important role when it comes to detecting fraud. It should be in their identity. And we think, and that was a result of the audit of the root cause analysis, that if fraud is in the role and in your mind, in your inner behavior as an auditor, it is much easier when you are talking with a client, when you are auditing in an entity, to detect fraud or to see signals that of strange behavior, etc. But when you see fraud only as a tick in the box and an issue that you should manage in your audit, then you have to be concerned if you see everything, because you have to see the difference between an error and an error due to fraud. And if you don't see that difference, then you will never be able to detect fraud and report on that. So when we look at the causes that we saw in the root cause analysis, you look to the inner circle, that's about the team and the individual as an accountant. The most important was the professional critical attitude of the auditor, and is the auditor able to ask the right questions? And why does an auditor not ask the right questions? That was most of the time, reason for that was that there was not enough knowledge on fraud. And then you should say there are audit standards in the Netherlands, audit standard 240. It's very clear what an auditor should do. But when an auditor doesn't have much experience with material fraud in his working life, then it's most of the time not very easy to see the difference between fraud and errors. Another thing was that has the auditor enough understanding about the client and the processes of the client? And then we can also say audit standard 315, what do you have to do to explain or to understand the processes of the client? So all these things have impact on the auditor as an individual, but also the team spirit. When you are a part of a team, there's always a senior member in your team, and then you got many biases because of team members that say you are not enough experienced with this client. We know this client very well, so if you have seen something sort of behavior, there are many biases why auditors don't investigate more or ask the right questions. That's also a thing of the experience of the audit firm, because when you are in an audit firm, you have other pressures like budget, pressures about planning, because and relationships that have influence on the role of the individual auditor or as a member of a team, because many clients are very important for the audit firm. And when it comes to methodology, we see that in the methodology, not all the time an auditor has an integrated research that fraud is part of the whole integrated audit approach. Fraud is sometimes also with compliance pressure. more or less a tick in the box that we have done it. We did research to fraud issues, fraud risk analysis in our audit, and we managed that. It should be part of the whole methodology. And when it becomes to the outside circle, the ecosystem, it's also important. What is the role of the chain? We see that because of pressure from a client, an auditor many times says yes, and sometimes he should say no, I can't do this. I can't deliver on time because you didn't deliver on time your files to the auditor. So there are many pressures in the environment of the auditor that makes that the auditors take steps behind or other steps and doesn't detect the fraud himself. When it comes to the interventions the MBR concluded out of the root cause analysis, you see them on the right side. We talked about them with the quartermasters, and those interventions, we got 5 interventions, and they are on the culture and behavior on the auditor. That's the most important, and also an awareness program of the MBR to get fraud back in the role identity of an auditor, of an accountant. The other interventions are about the education, because we also see that most of the auditors in practice are maybe old-fashioned, got an old-fashioned learning, where new and young auditors have more learning about culture and behavior. So we are going to do something in training and practice, but also more integrated auditor approach, and we are looking to get influence in the ecosystem. So maybe we should make standards for management and control systems of organizations, so to help auditors with that. You can skip the slide now, because I also want to say a little thing about the reporting in the Netherlands. Last year, we got an obligation in the Dutch standard 700 in the Netherlands. So all auditors have to report on fraud in the audit report. And that's not only on fraud risks, but also on the audit approach, what they do on specific fraud risks, and what are the results and conclusions out of that audit. That audit reporting was already done in the Netherlands for the PIEs in 2021, and next year it should be in all audits. That's a very important step, and with this step we see that auditors in practice are not always enough aware about what is in audit standard 240, because we see audit reports that are not very actual on the fraud risk that we want to see in those audit reports. That's what I want to say for the discussion. Thank you.
Thank you, Marianne, for this root cause analysis with a specific Dutch perspective, but I think with a broader sense and interest. So last but not least, we have now Nigel as a practitioner, as fraud detective. The floor is yours.
Thanks very much, Jens. And oops, it says unmute myself. Can you hear me now?
Yeah.
Yeah. Thanks very much, Jens. Thanks very much, Accountancy Europe and ICAW for the invitation. I guess I'm the joker in the pack, and I might say some things which will maybe provoke a little bit, but I was very pleased to hear the comments from the other panelists. Just very quickly, my background is I'm a chartered accountant. I trained as an auditor with the big 4 firms, one of the big 4. I've got a computer science degree, which did influence the rest of my career. I've been an internal auditor for 7 years in a big corporation. And after that, I was a financial controller And subsequently, the last 25 years, so I'm quite old, has been investigating fraud all around the world for large companies and government organizations. I would say, based on that, if you just look at the cost of fraud in the world, and whether it's estimated through different studies, and you put it at 5%, 6% of world GDP, one can say that fraud, if you define it widely, is probably the greatest unmanaged risk that we've ever faced in companies ever. And the problem is, the number is going up. And people say, has the number gone up? Even though we've had in the last 40 years infinitely more regulation, compliance, auditing standards and everything, why has it gone up? Well, my answer to that is it's gone up because we have had so much boxes to tick that we've not been able to see the obvious, which is following the money. Defining fraud, I want to give a people's definition of it, because we overcomplicate it. We make it far too complicated. It's anything deliberate and unethical, which causes financial damage and any harm to an organization. And typically what I've seen through hundreds of investigations is that the instigator of fraud and financial damage is often on the outside. It's suppliers that are greedy, customers that take too much, third parties, consultants, agents, and then we always get the odd employee or management that have this overdeveloped sense of entitlement that they want more. But we tend to focus on it and we tend to define it as internal and external fraud, which is not really much help. When it comes to auditors and accountants and financial management, one of the things is, should we do more about fraud? If it's 6% of world GDP, it affects every single organization in the world. So it shouldn't be a risk. And I liked, I think it was John who said it was number 13 on the list. It's not number 13, it's number 1. It's not even a risk. Well, death is a risk, some people say. One internal auditor said to me, death is a risk. I said, death is a certainty. At least I think so. Fraud is a certainty. It's a cost and it's a business process in every organization. It's an unwanted business process. And it's our duty, whether we're accountants, whether we're auditors, whether we're regulators, or whether we're just people working in the organization, to want to find it. But that's where the problem comes. The problem comes, and I was a financial controller in the USA. And one of the things I learned in the USA is if somebody asks you, how are you doing? The answer is, fine, thanks. And it's just the same as ISA 240, which Mariana took up. ISA 240, I was talking to a senior partner who's just retired. He trained with me, actually, in a big audit firm. And he said, yeah, ISA 240 is a tick in the box. It's, do you have any fraud management? No, thanks, great, brilliant, we'll move on. And that is exactly like the how you're doing, fine, thanks. So actually what we've done with these standards is we've made them box ticking exercises rather than real things that we should look into. So I would say that the answer simply is not should we do anything, it's of course we should do something, but it's where the we lies. If we carry on down the tack, and I think Catherine mentioned this, the external audit profession in the UK is getting so much blame. Now, one of my friends I went to school with is one of the editors in the Financial Times, and I keep seeing him and saying, stop blaming the external auditors. It's everyone's fault that we have totally failed in the last 40 years to deal with the cost of financial damage, which is caused by fraud. So I think it's very much a we, and basically it goes back to audits still use samples. We should use computers. Computers actually will do 100% audit if we use them well. We shouldn't use automated robots to do auditing, it should be us. But financial controllers, auditors can all actually look for fraud, and it's very, very easy to find if you want to look. Okay, that's my bit over.
Thank you, Nigel. It's exactly what we expected from you, giving us some further and broader perspectives, and thank you for sharing your experiences. And you touched a point about the understanding what we are meaning by fraud. Is it possible somehow to define fraud on which we should talk? Because also you mentioned what there might be small fraud issues, non-material issues, but what is the fraud dimension we are talking about? and I would like to start perhaps with you, Ward, to explain a little bit what you're meaning with not so important and much more important fraud cases.
Well, I mean, I think the reason why I mentioned is, of course, that we look at this issue at this stage from the perspective of corporate reporting. And I think there are many cases of fraud which are minor. People in a company, they take with them, I don't know, stationery, paper. They might take computers. They might take bigger stuff. And of course, this is important. And I think that Nigel basically also was saying, okay, employees, they take stuff. This is a fraud. I think this is an issue for a company, but it does not directly or necessarily impact the financial reporting process. And so from that perspective, it's less relevant. Of course, for the company, it's not irrelevant. And I'm sure that there should be good processes in place to ensure that this is being basically checked, that this is being managed in a careful manner. But that was really from the perspective that we in the European Commission we look at this issue in particular from the perspective of the financial reporting process. And that is also what our legislation, at least at this stage, is doing.
Thank you. Catherine, from your perspective, is there a difference between perhaps the management fraud or the top management fraud and this, I would say, everyday fraud, as you have described it, what happens in companies? What is your perspective from the consultation with auditors and audited committee chair? Is there an awareness of that big problem?
This is an important subject because the newspapers, they know fraud when they see it, and the implication is that fraud is obvious for anyone with eyes to see, and that somehow auditors are deliberately missing this or hearing no evil, seeing no evil. The reality is that fraud, and material fraud in particular, when we're talking about financial reporting fraud, is invariably complex. It's why we have complex fraud trials. If it was straightforward, they wouldn't be complex. Lots of different types of fraud. The shrinkage of stock, misappropriation of small assets, that's the certainty that's never going away. What really gets the newspapers excited, though, is management fraud, management spending money, company money on private expenses, for lavish lunches, for whatever. And when we hear standard setters and regulators say that all management fraud or all senior management fraud is by definition material because such people stand in a position of trust, the net effect of that is asking auditors to go through every single expense claim of management and senior management. Now, the cost of that is just totally out of proportion to what you're going to find. And it's getting over that somewhat sensationalist approach to this. Surely we must punish the directors who are using company money to spend it on lavish lunches for their friends instead of proper company business. That's a really difficult one, but I think it's an area in which people have to face the fact that if you really want auditors to do that sort of forensic work, it's going to cost a heck of a lot of money. Fraud is obvious with hindsight. We've always said this, but fraud in all jurisdictions is something that's ultimately determined by the courts. It's a battle we're never really going to win because the fraudsters are always going to keep one step ahead. But I think educating, getting a dialogue with the media in particular on what all of this really means is quite hard because it's not good copy. We're dealing with a technically complex subject, easier to write simplistic headlines.
Thank you, Kathleen. John, we have heard that Nigel is talking about all types of fraud, and as an internal auditor, you should be interested in the processes which are covering every situations. But isn't it from a internal audit perspective especially challenging to look at management fraud, because you are, even if you are independent, you are somehow part of the corporate governance system? What are your experiences in this differentiation between the compliance-driven fraud, internal fraud audit, and the top management fraud issues?
Yeah, that of course is a very that's not making our life easier. I think internal audit looks at fraud more broader than only corporate reporting fraud. Of course, it's basically every misuse of power, money, and favors for personal gain. So it's much broader. And I think if you look at that, we will also look at smaller frauds if we can. If we run into them in an audit, or there's a signal coming from a speak up or a whistleblower case, and we will investigate, as I explained, together with risk management and compliance sometimes, because the experience that I have is that every fraud starts very small. So if you don't pay attention to the smaller mishaps, then you might miss the moment to adjust and then have the big one. And also, I think there is no materiality involved in fraud, and certainly not if it is about behavior. And if you have good consequence management from senior management on small fraud cases, it also determines the tone the tone from the top in that respect. And so it's also a very preventive measure. And before I get to the real answer, I would like to also react to Catherine, because for me, expense claiming, every time I change a company, which I do every 7 years to stay independent, every time one of the first things I order my team to do is an audit on expenses, because expenses show integrity of people. And even if it's about 10 euro or 10 pounds or whatever we talk about, it's showing integrity. And then I get to your question on senior management, because unfortunately in a number of companies I worked for, it was senior management being at least very sloppy with their expenses. And then if it's about senior management and there's only sloppiness, but people find it looks like fraud. So I think as internal auditor, of course, we are paid by the business, but we always report in a one-tier system to the chair of the audit committee, and the two-tier system mostly to the CEO with a dotted line to that audit committee chair. That's the moment where the internal auditor needs to show his independence. So when it is about senior management committing small or whatever kind of level of fraud, it's their bad luck. It should not be the bad luck of the auditor.
Thank you. Marianne, from your root cause analysis, we have heard now also from John about culture, tone at the top, behavior. What are your findings in this respect?
Yes, those are the most important things, I think. And when it comes to audit on fraud, in practice, we see that auditors are very technical. Their approach is very technical when it comes to fraud. But most important are soft controls, behavior, those kind of things. And the question is, if our auditors experience to look at those behaviors, do they recognize strange behaviors? Do they talk enough to people in organization, maybe internal auditors, many different people? When it comes to fraud, we see that auditors use forensic expertise in their teams. And what we want is that all auditors have more things in mind, and more professional skepticism, that they look to management, to the role of management, the issues of the management, the questions and the answers, because sometimes you ask questions, but the answers, they are very widen and not on the question. What does that mean? Are you aware of that, or are you making a tick in the box? So I had asked my questions, and I leave this question, and fraud is in my file. But I think culture and behavior, it's the most important, and that's why we make a program in the Netherlands on that aspect. And that's a very hard program, I think. We talk now with many people about that because it's not enough in the education. It's not in the permanent education. So we have to do something on that.
Thank you. Catherine, you want to come back to the previous comments, please?
Thank you. And I really wanted to reflect what Marianne has just said about culture. Both the auditors that we spoke to for the first publication and the audit committee chairs that we've been speaking to for the second publication really emphasize this. And this has changed over the last 20 years. One example of this from the audit committee chairs, one of them said to us, it used to be the case, don't bring me problems, bring me solutions. He wasn't interested in that. He said, I want to know what the problems are. I won't fire you if you tell me what the problems are, but I will have a problem if you try and hide them from me. And it's that culture of openness and transparency that we're seeing in the better quality audit committee chairs that we interview that represents the change. And similarly with the auditors, I think probably several of us on this call have been external auditors years ago, and the culture really has changed in terms of what John referred to as we don't ignore the signs of sloppiness among senior management. So if you do find an expense claim that's 10 euros out, that is a red flag. And you need to do something about that. Why is that 10 euros out? So we're not ignoring that, but we are acknowledging that if we want to go through every expense claim, and if we want the external auditors to do that rather than the internal auditors, that's going to take up resource. That was all. Thank you.
Thank you, Catherine. Nigel, we have via Slido a comment on your intervention, so I would like to read it and then perhaps listen to your reaction on that.
Sure.
It said, I disagree with Nigel. From an auditor's perspective, management perpetrated fraud is a much bigger issue than other types because management can't be relied upon. Your reaction?
Well, thank you for the question, and thank you for disagreeing with me, whoever asked that. I would say, if you say management can't be relied upon, that's a little bit sad. But at the same time, it's good to be professionally skeptical. I would say, I will just clarify what I said. I would agree with the person that management fraud, if it's just management fraud acting entirely on their own to cover things up, can be hard to find. However, nearly every single fraud that I've investigated, which involved the senior management or a level of management, has always been easier to discover by looking at the outside parties that they're colluding with. Because whether it was Enron or whether it was many of the cases that I worked on, there's always a third party involved in almost every other case. If it's pure reporting fraud and it's just a journal voucher that's put out of place, that should be very easy to spot if it's big. The other thing I'd like to say is do look for the big money, but I agree with John about looking for the small money because the small money indicates the big money. And as Catherine said, any small thing out of place can indicate. I was actually looking at one yesterday, and it was a supplier selling to the management, and somewhere on the invoices, they were never giving any credit notes back, but on one invoice it said spare parts, 55,000 dead, and it gave a whole list of spare. That is never possible with all the spare parts, etc., to be a round number. that round number, actually, we explored it in a day, and it actually showed collusion with the senior management with the supplier, because they were just letting the supplier invoice them for as much as they wanted, and then taking a kickback on the side. So sometimes it's the attention to the detail, and it's to follow the money, which is the way you will discover senior management fraud. So I would say absolutely right, not to have to be healthy and curious, that you don't trust anyone as an auditor, but at the same time, pay attention to the details and follow the money.
If I may add another question, because you talked about indicators, and John, you talked about signals, and by that I think it's important to question which are the common signals and indicators, Nigel.
I think the best indicators. I think the phrase "follow the money" comes from the Watergate scandal. If you want to follow the people, that's also an intrusion into people's lives. If you want to say which employees have a company registered at their home address, that's usually breaching some sort of privacy acts. If you want to start surveying people, that's generally intruding on people's privacy. But money talks. If you look at the simple money flows in the company and you see irregularities in the money flows, small or big, those are the best indicators. They're also the least intrusive. And with the fact that we actually have computers, we can actually analyze money flows, and we can see things happening, which then lead you to see the frauds that are happening in the company.
John, do you want to add something about signals or indicators from your experience?
Yeah, maybe just a few, because I remember when I worked for a larger bank in the Netherlands in the past, that when we investigated a fraud, and we also saw that the way that specific entity was performing was basically atypical for what the market was doing, and that kind of signals, we need to take them into account. And the same was being there, looking at the culture. It seemed that the local compliance officer was just too shy, was not able to bring up the matters that needed to bring up, and didn't pick up the phone and called to Amsterdam in this case. And so that kind of signals, you see them, and at that point they may not seem that important, but looking back, they were important. And that's why in that bank we made it a routine to have a quarterly meeting with departments like legal, compliance, risk management, in order to sit together and to also have a view on what are the softer elements that we are seeing, and see whether there's a pattern in that. And the funny thing is, we did a training which is called frauding from somebody in the Netherlands who has a PhD on fraud, and she was telling us that more and more internal audit shops, but also external audit firms, they even use profiling to use data that are available in the company to look at where the risks are and where you could have a successful audit on fraud. So I think a lot is changing, but the signals are out there. We just have to grab them and combine them, and then be very careful in auditing.
Thank you, John. So we have tried to understand what we mean by fraud and which type of frauds are there. I would like now to come to the role and responsibilities. What you have described a little bit the ecosystem in which we are here, and what are the roles played by the key actors? And we have seen by the consultation the three pillars or columns of corporate reporting ecosystem. What is your analysis? And we have heard a little bit about, but could you please give us a deeper insight on your views on this interaction between the key players?
Well, as mentioned, the approach that we have taken is to look at the entire ecosystem. The three pillars of corporate reporting, they support each other. Now, there are certain legislative responsibilities for each of the pillars. As said, the correctness of the reporting is in the first place responsibility of the company. I think that's very clear. The auditor has a very important role given by the legislator, a public interest role, to basically give assurance on the corporate reporting. And then the supervisor is in a way the backstop. Now, looking at the consultation results that we have done, it is also quite clear that many point to the corporate governance pillar as needing most basically improvements. But I think it's very difficult only to look at one pillar. We need to look at all the three pillars. If a company board is not sufficiently supervised, for instance, and doesn't feel sufficient pressure from the supervisor, of course, there is less of an incentive to look at these issues. I'm not saying that the company boards have no interest themselves already to look at these issues, but of course it helps a little bit if somebody is looking with you at the correctness of your reporting. And of course, if the company feels that there is supervision on the corporate reporting, and I'm speaking here more generally, not only about fraud, then of course it also leaves more of a role to the auditor to take a serious look. So overall, I think that we can say that the three pillars, they work in a cooperative manner, and they support each other, they need each other. So we cannot basically just point to one pillar and say, no, this is entirely the responsibility of the corporate governance, or this is entirely the responsibility of the auditor or of the supervisor, but they should work cooperatively together. And I think in this overall system, I think it's very important that the right balance is maintained. As said in the consultation, many pointed to the corporate governance pillar as needing the most reforms. This might have also been due to the fact that there are many auditors reacting to this public consultation. Of course, everybody looks at their own pillar and concludes, no, the problem is not with me or not mostly with me, it's in another pillar. But I think it's very clear also that corporate governance is a key element. Also, for the moment, the primary responsibility of companies to ensure the correctness of their own reporting.
Thank you, Bart. Catherine, here's a question from the audience based on your interviews. Does you think that audit committee chairs take manager perpetrated financial misstatement fraud seriously enough? So this is about the role who is taking fraud risk seriously.
Thank you. It's a good question. I think audit committee chairs, or certainly the audit committee chairs that we spoke to, and they're obviously the better audit committee chairs, do take manager perpetrated financial statement seriously, certainly more seriously than they used to. In terms of when we ask them what keeps them awake at night, they focused on the unknowns, the things that management didn't tell them. They're all acutely aware that they are very reliant on information from management, but for that reason, relatively recent innovations such as whistleblowing come up remarkably high on the agendas of all the people, that all the audit committee chairs that we spoke to, not because a lot of what's reported on whistleblowing helplines or whatever isn't completely irrelevant to what they do, but because sometimes it's an independent channel. It's not coming through management, and we were surprised to hear the number of times whistleblowing and acting on whistleblowing was important for people. Our audit committee chairs talked about bypassing management in some cases. I mean, obviously they need to cooperate with management, but actually walking the floor and talking to people, having a direct line of management to internal auditors. It's an elementary the elementary enough stuff, but that's what keeps them awake at night, is that the company fails because of a management fraud that they knew absolutely nothing about. No audit committee chair sets out to miss one of these types of frauds. But if I can come to the question about what are the respective roles, really good to hear Ward talk about the corporate governance pillar. Another example of this, one of the audit committee chairs, who's a previous auditor, he said he resents massively the implication that he can't be trusted to tell the truth if the auditors haven't crawled all over everything that he's written down. And it's somehow as if we expect directors to misbehave. And we sort of accept that bad behavior, which is why we put the auditors in there in the first place. We should expect better of directors. And you know, audit committee chairs are directors of company. They resent the idea that they're simply not trusted, and it's just assumed that that is the way the world is. The tone at the top, that was mentioned. The culture was mentioned, particularly where you've got a culture, an external culture, a culture that everybody's required to sign up to. There's a lot of signing up to mission statements, but what's actually happening on the ground is something completely and utterly different. And I think people are becoming aware that where there is a difference between those things, you have to deal with it, and not just what you can document in terms of process, but what you felt and what you heard when you were talking to people. All good questions.
Thank you. Nigel, you want to intervene?
Sorry, I didn't mean to jump the queue or anything. So I just wanted to comment. I think I'm really liking the comments, especially when Ward started off talking about 3 pillars. Just want to, to reframe this, to frame this. Fraud is, if it's 6% or something of world GDP, every company has it. So maybe you don't know about the playwright Oscar Wilde, but if he had been alive today, he would have said, there's only one thing worse than finding fraud, and that's not finding it. And it's really, if you think of it in a context, if you think of the 3 pillars, the management should be saying, if we've not discovered material fraud, now I don't mean management fraud, I mean someone, a supplier hoodwinking the company. If we only look and say we don't trust the management, that spreads distrust. If we say that the only control that we really want to rely on is whistleblowers, it'll become like the Deutschland Democratic Republic many years ago, where with trying to get everyone to whistleblow, that creates distrust and that creates more damage. If you say to the management, you could have been hoodwinked by someone, an external party could have cheated you, you could have been, then people are more open to talk about it. So one of the things that needs to be done is, and this is taken right through my interpretation of ISA 240, which I grew up with. It was one of the things I commented with on, and I gave comment to the exposure draft years ago. It's that you should be able to say, where is fraud happening in the organization? So who are the actors? They could be management, they could be suppliers, they could be customers, they could be external parties. If you use the methodology, think like a thief. It's exactly the same methodology car companies use to stop people breaking in. If you think like someone who wants to break in, how will you get around the controls? As soon as you start doing that, you start discovering what types of fraud are happening. And then the second technique is to follow the money. Which is no one's doing anymore because everything is going through systems where people just tick boxes. These days, when payments are approved, they go through an automatic system where someone doesn't look at it and just clicks a button and ticks a box. So it's back to the 3 pillars, that all 3 pillars need to think like a thief and all 3 pillars need to follow the money. Now, that's quite unusual when it comes to the supervisory boards, but for the management and the auditors, they have full access to the accounting systems. And going back to accounting, it's debits and credits, it's money in, money out. If you follow that money and you look at journal vouchers, you will see most frauds that are happening, but you have to want to see it and you have to say, assume that it is there rather than that it's not there. That's all.
Thank you, Nigel. Marianne, we have now heard many times that the auditor has his risk-based approach, and perhaps a forensic approach is a little bit different. From your discussion with the 12 accountancy firms and their methodology, what is your observation? in the methodology of the firms, of the auditors, and the best practice perhaps also, when to change from one approach to the other one, because it, as Nigel mentioned, it's a tricky issue to say now I'm in.
Yes, good question. Because all auditors have to make risk assessments in their team, and the difference between forensic auditors or forensic expertise is, I think, because forensic expertise in the Netherlands, there's not an education for that. So the only difference is that you have much more experience with real life frauds. You did researches on fraud. You talk more with management in fraud cases. So forensic expertise is experience with real life frauds. And follow up by companies, by auditors. So I think in the planning part of the audit, when it comes to fraud risk assessment, forensic experts can help you to get more critical look to behaviors, talk and research as a fraudster. So with fraud in mind, ask questions. Are that the real fraud risks in your for this entity to make follow up on? But what we also see, last year we did some research to forensic expertise in practice, that we don't have enough of that. So if we think it would be nice that we get some audit support in the planning part of the audit, then we should also have enough capacity of persons who can deliver that. And in the Netherlands, we see that there's not enough capacity. So I think the solution is, and that's part of our intervention, that all auditors need to learn, think as a forensic expert. Think as more experience is very important, but when you haven't seen a fraud in practice, then you get to learn that experience. And maybe we should frame frauds, we should take more role plays. So we need to learn auditors to discover, to look at behaviors, to learn in fraud cases, etc., and think as somebody with a forensic mind. That's where we think the solution is.
Thank you, Marianne.
So only bring a forensic expert in your team who doesn't know your client. I think that's not a solution.
Thank you, Marianne. Catherine, I have two questions. The one is following Marianne's explanation. The question whether greater number of specialists and forensic involvement in the audit. You have talked to the audit firms. What is best practice there? That would be my first question. But the other one you mentioned in your introductory statement, the prevention cost against the detection cost a little bit. So I would like to come back to this too. Perhaps you can start with the first part and then to the second.
The specialist question is a good one, and thank you for the opportunity to respond to this. Those who've been involved with the PCAOB standard setting may remember that there was a proposal quite a few years ago now for a forensic stage to the audit, and that wasn't taken up for all the reasons that Marianne pointed out, and that is forensic specialists have different skills. They approach it in a different way. They deal with known frauds, basically. They find out what happens. What they're not expert at, which is what auditors are being asked to do, which is to find the fraud in the first place. as part of our audit reform programme in the UK, our regulator changed the UK version of ISO 240 a couple of 3 years ago now, with a specific additional requirement for auditors to consider the need for the use of forensic specialists in an audit. Now, of course, in the vast majority of cases, they won't be needed because you won't have this risk flagged. But it does make auditors, particularly of very large companies, step back and think. Now, this idea that you only get forensic specialists in when you've already identified a fraud, we do know that at least one firm, and I think from memory two, are now saying we're actually including forensic specialists at the planning stage of the audit in some cases, and they haven't done that before. The idea that you have what they do is they bring a whole massive experience to bear on the audit, and it's not knowing how these frauds take place, certainly at a junior staff level, that constitutes the problem. It's experience of them. And one of the big issues that we've had in many representations to standard setters, but also to regulators recently, is that all of us in this ecosystem need to share more. There was a proposal in our audit reform for a database of frauds to be set up that everybody could consult, but nobody wanted responsibility for it. The firms said, well, we can't possibly do that because of client confidentiality. And the regulators said the same thing. We can't do that. It would be giving too much away. We have to find a way as stakeholders to share the huge amount of information that there is within the firms, within the regulators, and indeed within government, to bring that all together. And I think we all have a responsibility to look at how we can cooperate better in that respect. Prevention and detection cost. That's a really good question. We're told that cost is big issue. Audit cost is a big issue for companies, but when you look at the the cost of the audit by comparison with turnover of companies, it's not that a significant figure in some cases, and surely it's worth more than the damage that can be done when people's livelihoods and pensions and jobs and all the rest of it are brought into. Basically, what we said right at the outset of the fraud publication is that what we hope it does is that it raises awareness so that fraudsters have fewer places to hide. That's the whole point of improving internal controls. We did a couple of interviews-based publications when we thought we were going to get SOX in the UK on internal controls, and that's always the idea. You're not going to eliminate it, but you push the boundaries further and further and further away. It's a cyclical thing to a certain extent. There are estimates of costs. I have to say, they're based on some pretty big assumptions. I'm glad that there are people who do those estimates, but clearly prevention in terms of controls has to be better than detection, but it comes at a very substantial cost.
Thank you, Catherine. John, you as an internal auditor, you are always confronted with a discussion on costs of the function of internal audit and prevention. What is your thought about this discussion, cost for prevention versus cost for detection?
Well, to be honest, if I enter into a new job as chief audit executive, I always tell them that I should not be limited by budget. And certainly in a case when there is suspicion of fraud, I didn't meet any board member or any committee, executive committee member who stopped me in doing that, because at that point they want to know what is happening. And I think listening to Catherine and to Marianne, I fully concur with that. The only point I would like to mention here is that to let's say limit the cost of fraud detection, we should also use things like process mining much more. because in regular audits, we use process mining to check whether everything went according to the process and the right people authorizing things and the like. And there you sometimes see in process mining that the transaction keeps on circling, and that's a signal that somebody is trying to push something through without having the right credentials or something. And when you look into these individual cases, they often are, well, fraud found immediately. And I think automation, and I think Nigel said the same, automation is something we should use to really look at the full data set and to look at the exceptions. But there, of course, you run into the problem of data quality. But as that moves up to the right level, I think it enables us to not only follow the money, but also follow the procedures really closely.
You're on mute, Jens.
Can you hear me?
Yeah.
Jens, sorry, we cannot hear you anymore.
Hello? Can you hear me?
It goes on and off.
Hear me now?
Yes.
Can you hear me?
Yes, we can. But I think that the microphone, when you move, it goes off again. No, we don't hear you.
Haroon?
Yes, Maria.
Maybe I have a question for the other members in this.
Okay, yeah, why not?
Should it help if companies had to report in their annual statements about fraud risks and the measures they took into the organization, the control system? Would that help that there would be more transparency needed from out of the responsibility of companies themselves? Would that make a better mindset or etc. For fraud? That's a question, because in the Netherlands we also talk to politics, and we want to have a sort of risk assessment in annual accounts, in financial statements, and also about fraud risk.
Thank you, Marianne, if I may, because there are some questions on Slido about this too. So how to force companies to do more or to report more? Is there a need for changing legislation, regulation, more rules, or it's already within the current framework, we can do more together, etc.? So I think it's a question open to everyone. Ward, if you would like to take the first.
Yeah, sure, with pleasure. No, I think what I tried to say in my introductory remarks is basically, if we look at the current provisions of the accounting directive, where it says that listed companies should state in their corporate governance statement, should give a description of the main features of the undertaking's internal control and risk management system in relation to the financial reporting process. And that is in a way a key provision. But what this does basically is to give a description of basically the systems that are in place, which on one hand doesn't basically say, give the assessment of the company itself, whether all of this is effective, and basically what the company has seen when it was looking into these systems. So in a way, this is a very good starting point. It's important that the company has to be transparent about these systems. But what you can say is that it is a rather generic request from a company. because you can describe whatever you want. It can remain rather generic, and it doesn't give any, or the company doesn't have to take responsibility for the effectiveness of these systems. It doesn't have to indicate any issues that it potentially sees. It doesn't have to point out possible problems in this area. So there is certainly, I think, a possibility to reflect further about whether this should be changed to make it more effective.
Thank you, Ward. I'm back. Nigel, would you like to come here in from your perspective, please?
Well, thank you very much. I don't want to hog this. I just think that we need a mindset shift, and the mindset shift has to be people want to find things. If we start focusing on insiders, that's going to create distrust. But if we say the 3 pillars should want to find fraud, then I think that's going to change the whole mindset. So the KPI should be not that you didn't find anything. That should be a negative KPI, that you didn't find anything. But the other thing that's important is I'm not a fan, and this may be just throwing a cat among the pigeons, but I'm not a fan that every auditor needs to bring in a forensic specialist. Because actually, I wrote a book a couple of years ago called Recipes for the Aspiring Fraud Detective. And what I found out is when I teach people, every single person I've ever met can find fraud. So I would say everyone is a fraud detective. It's very simple. If everyone can read a bank statement, every single person can read a bank statement and see if there's something on their bank statement where they've been defrauded. So actually, every single human being, I've taught this to kids at schools as well, can spot fraud. So, and the other reason is forensic specialists means that the big 4 will then have an advantage because they have teams of that. The medium-sized firms won't get in there. And that's important to level the playing field, to say a normal person can spot it. If you think about whistleblowers also, most of those whistleblowers are never forensic specialists. They're just good people doing an honest job and then having to stick their neck out. So I don't think we should wait for whistleblowers. We should just say to everyone, go and look, we believe you. We give you confidence to see things, because you would do that at home. You would spot if a builder was overcharging you, so you can see that in your company as well. So that's all I wanted to say.
So I'm listening and hearing more or less a consensus on the discussion on educating people inside the companies, inside the firms, probably also the regulators to be more aware of these indicators, these factors, and get best practices on that. I think we are now here at a stage where I would like to motivate you, listener, to our webinar, to ask questions, further questions, and please use Slido, because we want now to come to a more interactive discussion with all of you. But before coming there, I would like to come back to one issue which was raised several times. It's a technology issue, and from your experience, Marianne, in your discussion with the firms, how important these new technologies which Nigel described are in the methodology, are they aware of?
Yes, I think they are aware of the impact of new technologies, and I think the big firms, they have the new technologies, but in the Netherlands most of the firms are smaller firms, and so the big accounts, they are audited by the big audit firms, but we have in the Netherlands 20,000 audits in 1 year. So if all auditors are connected with those innovative tools, etc. We don't know that as MBA, but we want to know that, and we also know that some small firms they are very, very innovative, but we would like it that the MBA should give tooling to all the companies in all the audit firms in the Netherlands. But I think companies they are more innovative, but it's not sure that, but I think that they are more innovative than the audit firms, because the audit firms, they have all the time to react to what the entities are doing. So I think they walk behind that, but I think there is much innovation in tooling, but it can be more.
Thank you. Here is a question from Slido. I think it's something for John. In practice, to what extent internal and external auditors discuss fraud, risk, managing these risk instances of fraud detected, etc.? What is your view?
Yeah, if I can start on this one, I think internal auditors and external auditors should be operating quite closely together, and certainly on culture and behavior, which in effect is a lot related to fraud. They should have maybe formal and informal conversations, because talking about signals and then even mentioning cases that might look suspicious but maybe need to be more investigated before you really have a point. Talking formally about it, putting it in the file of the external auditor is maybe not the smartest thing to do, because it will attract already a lot of attention even when there's nothing bad happening. But I think having periodical meetings to go over the softer signals that internal audit and external auditor see in performing their duties is extremely important in this sense.
Thank you, John. Catherine, do you have any practical feedback from your investigation or research made with audit committee chairs and firms?
Yes, there is a very active fraud discussion that needs to be particularly well documented these days, because it's something the audit inspectors focus on. There is much better communication generally with audit committees, generally between external auditors and audit committees when it comes to planning the audit. And as a result, I think you get a much better approach to systems. There's a better understanding of systems than there used to be. And of course, auditors, as Marianne said, now have the tools to interrogate systems that were barely imaginable a few years ago. But the frauds are sometimes in these systems, and obviously cyber. I mean, one of the things we heard over and over again were the cyber risks, and audit committee chairs admitted that they weren't on top of this, and that they probably weren't going to get on top of this for a very long time. But I don't think it's that sort of a risk. That it does keep them awake to an extent, but the sort of risks that excite the journalists, which are about basically financial reporting misrepresentation, is the area we've all got to look at a bit more carefully. The scope in accounting standards, the complexity in accounting standards that leads to the scope for that. All of these things are discussed. There's the whole issue of what do you do when you've approved a particular course of action, accounting policy, by giving it an unmodified audit report 1 year, and as you progress, there's the sense growing that actually this accounting treatment isn't right for the company. How do you help auditors intervene earlier and say, actually, we got it wrong 5 years ago, or things have changed? How do we deal with those really difficult circumstances and not simply carry on saying we can't face that abyss? So there are a lot of behavioral issues in this as well. So to what extent do internal, external auditors discuss fraud? I think they discuss them a lot. What they worry about is not discussing the right ones.
I can only agree with your remarks on the practice. Being audit committee chair, and just yesterday had a discussion with the external auditor. We had a substantial part of our discussion was on fraud. And when I compare this with the discussions 10 years ago in the same company or similar companies, it's a total different environment. It's not a shy issue where, may I ask a question, but we can also make it very briefly, etc. No, it was an open discussion. Which are your experience? You know what it is, etc. So I think there is a remarkable culture change. Here's another interesting question I would like to share. It's about if the management is involved in the fraud and hiding it from the auditors, isn't it a problem very difficult to overcome? And that's a question for Nigel as a forensic expert. What is your look at this possibility? You are a former auditor. You are now a forensic accountant. Is it nearly impossible for the auditor to detect such type of management fraud?
My simple answer is no. It's very easy to find it, but I don't know how to explain it in a few seconds why it's easy. I will give the mantra, which is follow the money, which is exactly all you need to do. It's not difficult. In every single case I've looked into where management have been hiding fraud from the auditors, it's very easy to hide fraud from the auditors. But the real comment I want to make is, how does an auditor feel, an external auditor feel, if they discover a fraud in this year, which has been going on for some years before? Because the problem is, then the client will then sue them for saying, you found it now, but you should have found it last year. So we had a case recently where the management was hiding the fraud. The auditors never found it. We went in and looked, and it found it in seconds. It was so easy because it was about following the money. The problem was we had to give the auditors an amnesty. We had to say to the auditors, listen, it's not your fault that you didn't find it last year, because if they went and started blaming the auditors, they wouldn't get the auditors on their side. And I'm not sure whether that was the right thing to do or the wrong thing to do, but we did it by saying to the auditors, don't worry that you didn't find it last year and the year before. So that's where the auditors are a bit scared to find something that they should have found the year before. So it's fine when you get a new audit firm coming in.
Thank you. And perhaps, Ward, another question which is more actual, and we all listen to the greenwashing discussion. And I would like to ask you whether corporate greenwashing is a form of corporate fraud. Perhaps you have some thoughts on this, because we are all discussing now the impact of greenwashing and all the ethical questions behind that behavior. What is your opinion on that, Ward?
Well, I mean, I think it's not possible to give a reply to that in abstracto. I think it depends very much on the situation, but I'm pretty much convinced that indeed greenwashing can be a form of corporate fraud. I guess in many cases it will not be formally a criminal fraud, but it's basically misleading customers, investors about whether a certain product is actually sustainable. And I think that is something that, given the climate crisis, the sustainability crisis that we're living, is something that we would absolutely like to avoid. But whether it's actually a corporate fraud, I mean, that has to be assessed on a case-by-case basis. And I'm sure that not in all cases it is actually corporate fraud. But of course, in any case, we should avoid all cases of greenwashing.
Thank you. Nigel, you want to intervene here?
Apologize to my co-panelists, but this is a very good question, because greenwashing is it's all sorts of covering up for things. Just one example. When we followed the money, we found some payments to employees in a factory in Far Asia, $100,000 each time. Found out that those employees had died at work, and the payments were made to the families as a sweetener so that the deaths wouldn't be reported in the factory on the sustainability report. And then we traced back the root cause, and the root cause came back to a mandate from head office saying, we had 3 deaths last year, we don't want any deaths this year. So the management simply did what they thought they should do, which was pretend that the deaths never happened at work. And they let them happen. And they said they happened at home. They were natural deaths, but because of the fact the company's nice, we paid them money to the family with a non-disclosure agreement. Now, any form of lying, cheating, covering up should be taken in as anything deliberate and dishonest, which is causing damage to the company because it causes damage to reputation. So my answer is all greenwashing is some form of fraud.
Thank you for this very, very interesting example. Catherine, do you have a view on that?
Yes, the audit committee chairs we spoke to were aware of this. It's a growing awareness, particularly in the light of the SEC's disclosure proposals. And the comment that was often made to us was, if we don't disclose anything, we're accused of hiding something. But whatever we disclose, we're accused of lying. So fraud, I think in both common law and civil jurisdictions, generally needs two things. It needs an element of dishonesty, and it needs some financial gain or the avoidance of loss. And Nigel's very succinctly pointed out that the avoidance of the reputational damage associated with that sort of thing is very much the financial loss. The dishonesty thing is it is a bit harder. I think there was a certain stoicism in their approach to this. There was an acknowledgement that they had to do this because that's what investors want, although they were very skeptical about the real value of some of these required disclosures, and an acknowledgement that it didn't matter what they do. If you say, if you say something, if you say nothing, you're not going to will with this. And again, it comes back to what I was saying earlier. There is an assumption that companies are dishonest and that directors are dishonest. And that's a shame. And when we come to regulation, perhaps we need to focus on not raising standards in that area, although that obviously needs to be done, but acknowledging that, or addressing the fact that most directors of most companies don't set out to be dishonest or even to be perceived as dishonest.
Thank you, Catherine. Marianne, do you want to intervene here too?
I agree with Catherine because I think when it comes to financial reporting, this is non-financial reporting. Also, I already mentioned fraud risks, etc. That's also not financial reporting. The auditor has a very important role, but that role should be made more clear in future what that role is, and if auditors are able to make that role. I think that's important. But when it comes to greenwashing, and there is an intention to reflect information that's not right, not correct, etc., then an auditor has to be aware of that in his role.
Thank you, Marianne. John, your views.
Yeah, I just wanted to, because I agree in principle with this, but I think with ESG coming to us, the world is changing, and also I think the way we should look at this. If there's greenwashing involved, it is part of where the external auditor has to provide assurance on really soon. And if we want to save the planet, we should maybe make greenwashing into a fraud, looking at it as a fraud. I've been reading the reporting standards that EFRAG is preparing, and next to the fact that they are huge and very wide and very detailed, it also clearly shows that it's not about the duty to report anymore, but it's about the duty to act. And in that sense, I think we should really look at greenwashing as a very material mishap, and whether we call it fraud or not, it should have the attention of all of us.
Thank you, John, for your statement. And perhaps we have learned also today that the attitude or the cultural background of doing greenwashing and doing the corporate fraud issues is very comparable and very similar. So it's about ethics and attitude and education. I would like to finalize the panel discussion by tour de table, by perhaps giving 1 or 2 sentences, 1 or 2 minutes, your main takeaway from our today's discussion, or your remark you want to make to give us a better picture on fraud in this context of a wider corporate ecosystem. I would like to start with you, Ward, if possible.
Yeah, sure. Thanks a lot, Jens. No, I have a few takeaways. First one is fraud is everywhere. It's a fact of life. Second point I took away from discussions, signals are always there, and also the total amount of possibilities that exist in terms of technology, etc., to detect this. And then also the willingness from the different sides to tackle this. So I'm sure that we can make progress in this area, given all these elements.
Thank you, Ward. Catherine.
Thank you. I think my main takeaway is I'm really pleased to hear the willingness to cooperate, because I think if we're to make progress against the fraudsters and to keep, push them further and further away, which in the end is what we all want to do, even though we're never going to get rid of them, we do need to work together on this. And instead of audit committee chairs accusing auditors and auditors accuse, internal and external, we need to work together. That's my main takeaway.
Thank you, Catherine. John.
Yeah, I agree with those, and I think I also sense that both external and internal auditors agree on the fact that raising awareness within our companies, but also to our staff, and accelerating training and education is important to have this really work. And I think it's also today for me was a very good start to sit as internal auditors together with the external auditors. And I think we should be doing it also to avoid that the focus is too much on the financial part of it, because there's a lot of non-financial fraud as well. And with ESG coming to us, this is a great moment to start working together more than we did in the past.
Thank you, John. Marianne.
Yes, I want to encourage auditors that fraud is everywhere, all day, everywhere, and that they will be more aware and proud on the profession they fulfill. Where the history of our profession was fraud, so be aware, be more proud, and take your role as an auditor.
Thank you, Marianne. Nigel.
Yes, you hear me? Yeah, thank you everyone for very inspiring thoughts. I was not expecting it to be this sort of discussion. What I'd like to say is, I'm not the world economist, but I think we're entering a financial recession where costs is the most important thing to save. Most people aren't fraudsters. So spreading an attitude of distrust and looking at people with a magnifying glass is not the right way to do it. Also, blaming people for not finding it is not the way, which is what I'm going to go and speak to my friend Jonathan Guthrie at the FT, and I'm going to say, stop doing it. Will you tell your whole paper to stop blaming external auditors? Because everybody, if they're encouraged in the right way, can spot fraud. And if there's no, if someone spots something, you don't say you should have spotted it earlier. You say, thank you. Thank you for saving and defending our organization against, I'm going to use a Harry Potter metaphor now, against the commercial dark arts, which are usually from the outside, sometimes from the inside, but it's very few people that practice them. Most people are honest, decent people wanting to do a better job, and we should encourage them in that direction with the enemy is not in the room. Maybe we should talk about not fraud, but we should talk about the cost of fraud and call it financial damage. That's my takeaway.
Thank you, Nigel, and thank you all of you. I would like to make a short wrap up, but I think you have mentioned the main points. We are now in challenging economic times. So the possibility of fraud is even perhaps higher. And what we learned, I think, is that a lot is there. So we heard about best practices and methodologies, processes, standards in corporations, in the audit firms. And what perhaps is important is to highlight best practices and to share best practices, so that in the whole ecosystem, the knowledge is shared. And I was very impressed by examples from the Netherlands and UK, where the institutes have done and are doing a lot to highlight the issue in the education program with the films, with other tools. But I think also the idea to share tools which are best equipped to follow the body, as you, Nigel, mentioned, or to investigate into the systems. So it's people, it's about education, it's about sharing and technology. But I think all about this is ethics, it's attitude, the culture, the tone at the top, the corporate culture, but also the culture in the firms. And if all these parts and all these people are working really together, audit committee chairs, internal auditors, external auditors, supervisory bodies, I think it is a good possibility to build on and to prevent future fraud cases. And perhaps for the regulator is perhaps to enhance those good practices. I think it's not necessary to reinvent the wheel and to give just another regulation, but it's more about introduction and implementation of best practices. So that's my takeaway. If you're agreeing, I'm happy. If not, we will continue the discussion. And thank you for your time, for all your commitment, and especially to the participants. Thank you. And we are interested in the further discussion and your feedback. Thank you and goodbye.
Thank you. Bye-bye.